Hello, boys and girls. I hope that everyone is doing well. On my side, I'm doing wonderful, except for my trading schedule of dropping videos. It's been a minute since I dropped a video, and I hope that you forgive me, honestly. I have no control over what is happening around the world. Life is taking me for a spin on a roller coaster through the ups and downs, right? So yeah, that's where I've been. I mentioned in my few videos that I posted for this year that I still have that job. I work at retail, for those that are wondering. I am a merchandiser. Imagine that, man. A skilled trader working a menial job, like being a merchandiser. Sounds insane, right? But yeah, that's what I do. I merchandise for a company, and I go around these big stores that are around South Africa, ShopRite, Pick and Pay, Spar, something like that. That's what I do. I merchandise certain products for those stores. And for the past few days, they've been moving me around, and it's impacted my schedule a lot. So yeah, that's why I haven't been dropping any videos, because yeah, man, it does get tiring. The work environment is just exhausting. That's one of the lowest tiers of jobs that any person can get. But yeah, man, we strive with what we have. We go forward with what we have. We don't cry about it. Did you know that trees don't cry about where they are planted? For real, they just grow and they bloom. So that's what I'm about. I bloom where I am planted. So nonetheless, I hope that you guys forgive me for being absent. Now, the step index chart that you're seeing here is on a daily time frame, obviously. That's what I like to trade. That's where I start, on a daily time frame, right? So we have a couple of things that I want to discuss on this daily time frame. But the first thing that I want to discuss is where we left off with July's price action. The last commentary we had was on the 12th of July. It was around this particular day, somewhere here. We were going bullish to rebalance these inefficiencies here. Now, we rebalanced all of those inefficiencies to the upside, and of course we used a daily key level, this particular wick here, this daily wick. 50% of that had a good discount area there. It's supported really nice, and I spoke about it in the previous commentaries, and I said that they will likely rebalance these inefficiencies, and they might want to target this particular high. So I was using this high as like a target for this particular bull run going to the upside to rebalance these inefficiencies. Now, they had no interest in going above this particular high. Now, this is one of those key ICT principles that we hold dear, because we may not get our target. Many times we don't know if our target is going to get hit. So I mentioned that if you have a trade and you're targeting a certain high or a certain low, be careful holding that particular trade, because sometimes your trade might not get hit. Your take profit might not reach up there, right? So we had this high as a target and it failed to get up there. Well, I have a thesis as to why it didn't get up there. Well, we just ran out of time. If you look at this particular high, it says the 15th of July 2026. It's right in the middle of the month, right in the heart of July, when price has no real energy to go up there. It's usually because of this particular time, the middle of the month. Now, if you look at any other chart except step index, any chart, whether you're trading gold, Nasdaq, bonds, currencies, whatever it is that you trade, around the mid-month of every time frame that you're looking at, or every symbol or instrument that you're looking at, this mid-month is going to have a high or a low. It's pretty significant. You cannot miss it. You can't miss it. It's right there. It's the middle of the month, right? We have a significant high or a low that tends to happen. Now, this is a concept that I teach right here on YouTube. You can look at the last year's commentary. I spoke about it. Now, when this significant high forms, it is usually referencing a PD array, a higher time frame PD array. So right here, we are referencing this bullish candlestick. Remember, I spoke about this range from this fair value gap, this high here, all the way down into this low. And I spoke about it. I said that from this range high to this low, we only had one up candlestick. And when we're bullish, I tried to attack that particular high. So we ran out of time. Price couldn't get up into that high. So it referenced this bearish order block. And it used that to go lower and attack the January 2026 low. Now, if you look at the January 2026 low, right, look at the date. The date says around the 20th, it printed this low. Now, that low wasn't random. It is scheduled, right? So we had this significant low that was printed in January, right? And it went up. So that significant low that was printed is engineered liquidity. So when price prints these significant swing lows and swing highs, it is usually timed based, right? So I'm going to give you an example, a live example as to how you can spot these significant highs or lows. Now, I am not enticing you to, predict that this is going to be the low or the high of the trend. I am not enticing you to do that. All right. And in fact, when we were talking about price, you remember in that, remember the market efficiency paradigm video that I posted, I spoke about this high, right? If you look at that particular high, when was it printed? In the 16th or 17th of May, right about here, right? So in the middle of the month, you have a significant high or a low. Now, I do not teach. You will never find me teaching how to spot these significant highs or lows. But I can give you a clear depiction as to how these significant highs or low form, right? And it's usually laced with some liquidity, right? So that's what we are doing down here. So today it is Tuesday. It is the 21st of July, and we went down here to take out that particular low, the January low. Now, I have a theory, right? If someone pushed the market lower into these relative equal lows from the 10th of July and the January low, these are relative equal lows. So if somebody came into the marketplace around the mid-month utilizing this bearish order block, they did not use your support and resistance theory. They did not use that. They used a significant key PD array, a bearish order block, to go short. Now, if they are going short right in the middle of the month, obviously they are going to take profit at these relative equal lows. Now, I teach that if you were entering in the middle of the month, suppose you had this insight that this bullish bias is just a fake rally to the upside, getting people into believing that we have printed a double bottom, right? They ram it lower and they do it very quickly, right? And they take out the sell side liquidity. A lot of people are gonna come into the marketplace and they're gonna think that the market really wants to continue going lower. But if you check your time, right? Check your time. It is the 21st of July on a Tuesday, right? And around the 20th, we have a reversal. Now, I'm gonna sound a little bit crazy, right? To most of y'all who are not well versed into my ICT concepts here in Step Index, it's gonna sound a little bit crazy, but suppose you entered into that mid-month high. Around the 20th, that's where you take your profit. You need to be careful, guys, around the 20th, because that's where a lot of reversals tend to occur. I mean, look at your January. January, on the 20th, we had that reversal, and it had this particular wick. That was a nice, significant low that was being printed here. I can give you more examples of the 20th being a reversal, and it was, in fact, a model that I traded last year, which was a swing trading model. Now, if you're trading this reversal and going the opposing direction, obviously the most significant high that you're going to target is the mid-month. Now, that's what I taught in my YouTube channel last year. You can look it up. Look at the very first video that was posted last year. The very first video. I was talking about the 20th reversals. Okay, so I'm gonna take the mid-month because I believe that's where price is going to go to if indeed we are having this reversal. So I'm gonna have it in blue color, right? So that is the target that we want to go to. It's a swing trade, good people, if indeed they want to reverse the market and go the other direction, and they do it at a particular time, which is the 20th. We're going to be looking for clues if price wants to reverse and go into the mid-month, and possibly it could reach up into these relative equal highs, right? So we're going to drop down on the 1 minute time frame, and we're going to look for clues. After the 20th, we are going to look for clues that support our new bullish bias. All right, so that's what we're going to do here. So let's drop down into the 1 minute time frame. So this is our 1 minute time frame here on Step Index. We are looking for ideas that we have a reversal that is going to go to the 15th of July, right? So these are the signs that you would be looking for if you want to participate in this reversal, right? So remember the framework that I did back in June, just last month of June. I did a framework video, indicating to you the setup that I trade and when do I anticipate that setup forming, right? So I'm going to be giving you the algorithmic signatures that relates to that particular framework, right? So when I'm in the 1 minute time frame, I am just looking for these signatures. The number one on the list is liquidity, right? So we had this initial low of the day, right, being printed right here, and price action was not in a hurry to do anything as of yet. It was in a consolidation. Now, whenever price action is in a consolidation, just know that a big move is on the way. Remember, we had that consolidation in June's price action. It lasted for a while, and then what did we have? We had the June mega trade. Yep, It's something similar to that. So we're having this tiny consolidation. A lot of people get frustrated when they are seeing a consolidation. Well, I'm not frustrated. I am not frustrated. In fact, I am happy that a consolidation is happening because I know just after the consolidation, we are going to have a massive move, a big one, a big one, right? So whenever I see that consolidation occurring at a time like the 21st of July, when I see that consolidation happening, just know that I am all over the marketplace. I am all over it. So I'm going to be looking for these price signatures that support my bias. I have a bullish bias. I am anticipating that the market is going to reverse and attack the mid-month of July. So inside of this consolidation, what needs to happen first? We have the buy side and we have the sell side, right? So the sell side has already been annotated, which is the initial low of the day. And that initial low of the day is right here. It is 7,654.3. That's the key level. That is our support. Now, our high or our consolidation high is right here in the 731 or 730. It is situated in 7,669.3. So we have our range high and range low. If I have a bullish bias, I need to see the sell side being taken first. Why does the sell side need to be taken out first? Well, that is to throw out everybody in the wrong direction because they want to take the market up. So if they are going to take the market up, they first need to drop down the market in order for many uninformed retail traders to chase the market going lower. You know those guys that trade breakouts? They are down here. They are trapped. As soon as the market broke below that low, many people did what? They looked for a continuation on the downside. So when price was going up like this, reaching into that resistance high, what did they have here? They had a short trade. If it's going to resist on that high, then they will take a short. But that's where the problem is. They are not aware that we have the 10 a.m. 10 a.m. in the real world markets. You know, if you're trading currencies, if you're trading a NASDAQ, metals, your gold, that 10 a.m. hour, it represents the second round of the news. Now, the second round of the news, it really does something in the marketplace. It moves a lot. So if you're not aware of that 10 a.m. hour, just know that here in Step Index, it has a significant high or a low that can be printed. And just after an hour, after 10 a.m., we had the 11 o'clock. Now, 11 o'clock, it is profit taking. Right around here, it is 7:30. So those people that had sold short with that resistance down here, they are taking profit. Why are they taking profit? Because the market at that 11 o'clock hour, which is really profit taking, if they don't take profit, it is going to reverse. It has that potential to reverse against them, especially around the 20th. Now, today it is the 21st, and we had that reversal. I was not part of this reversal, but it's fine. I just know that that particular mid-month high is going to be attacked. So I have a lot of days before we can get up there. So this setup that I missed is still okay, still okay. So let me zoom in, and so we can see the 7 a.m. Remember that orange fair value gaps, they represent New York. So here is the New York inefficiency right here. It is 7 o'clock. So 7 o'clock to 7:30 right here. That is when I look for my fair value gap. So it formed right in the opening. It had that inefficiency right in the opening of 7 a.m. right? Remember that we had the low of the day right down here. And down here, we had the 6 a.m. 6 a.m. begins New York opening session. So we had the New York session open, nested with the low of the day. So initially, these lows down here, they need to be taken out. So how does price action take out those relative equal lows? How do they do it? Well, they print the 730 high and they drop it massively. They create a market structure shift. And after that market structure shift has been taken, has been printed, they roll the market up and they try to rebalance these inefficiencies, right? They don't respect our 7 a.m. fair value gap yet. They move around, they rebalance, right? And finally, they decide to drop it and they create a market structure shift. After they have created that market structure shift, we then see this inefficiency that was printed. Now, this inefficiency that was printed around 8:48, that's the inefficiency that I would incorporate with our New York opening range fair value gap. So we go up and touch our fair value gap and we drop lower into the sell side liquidities. So we have taken the sell side liquidity, and one of the characteristics that I tend to look for if I am anticipating a reversal around the 20th, I like to look for these inefficiencies that are left open. Now we will leave it in gray color. So we have this inefficiency that was left open. That is beautiful. If I see those inefficiencies around the 20th being left out like this, I know that this inefficiency, if we get above the New York opening range, fair value gap, if we get above that, I know that we are going to support on it because we left this inefficiency. We said, no, sir, I don't want to come back to visit that fair value gap. The fair value gap that we're going to use to support is the New York opening range. Now, this New York opening range, we went above it, right? We went all the way up and created these relative equal highs. And after those relative equal highs were created, we dropped lower and we supported on our inefficiency. And we did that at what time? The PM session. So our PM session, it had started at 11 o'clock. 11 o'clock, we have a reversal. If you had shorted the market around 8 o'clock, 9 o'clock, or even this particular high, around 11 o'clock, if you are not out of your trade, then you are going to be in trouble because we have a reversal that tends to occur at 11 o'clock. So in the PM session, right around the 1 o'clock hour, we had these relative equal lows here being printed, and we had this big, massive push to the upside. So now we are going to operate in our PM session. We are above our New York opening range fair value gap. Now, if we are going to use the PM session, where is the PM session opening range? Well, after 130, 130 is right here. Now, this 130, you can clearly see that we don't have a fair value gap. We have a fair value gap, which is here. This huge fair value gap that is going to the downside, that's the one. That is our PM session fair value gap. So we're going to take it from the high down into the low. But if it has a volume imbalance like this, we take the entirety of the fair value gap. So since it is a New York fair value gap, we are going to have this yellow color. Now, as you can see, we kind of rebalance the inefficiency, right? We color in the fair value gap high and in the fair value gap low. See that? That is beautiful. Algorithmic price signature right there, right? We should support on that PM session fair value gap and go up. What did we do? We did just that. We went up. So anytime price action comes back into our PM session fair value gap, it is going to support and send price higher. So it's trading right around here. Maybe we could come back down and treat that as a support. I don't know really, but that is the model that I trade. So I'm expecting a bullish bias from now on. And these opening ranges, the New York fair value gap has supported price action and went up. And our PM session as well has supported price action and went up. So these two inefficiencies and this one down here, which is the breakaway gap, these are all supporting structures that price action wants to go up. So that's what I'm anticipating for our 20th reversal. For those guys last year that were watching me, trade the swing trade model that I did last year, for those guys that saw me trade the swing trading model last year, and I was doing that on the 15 minutes time frame, by the way. So this is like a watered version of it, but on the 1 minute time frame. So I hope this video has given you some bit of light as to how to trade and anticipate the 20th reversal. So that is it for me, guys. I will see you guys on the next video.